In this module, we are going to take what we learned in the last module on how costs behave. That is, the variable costs and the fixed costs. And we're going to develop it into what we call a cost volume profit analysis model. Okay, now there are 5 components to this cost volume profit analysis. We're going to deal with 4 in this module, and the 5th one, which is sales mix, will be in the next module. So we're going to go back and revisit now the contribution margin, as that's so important in helping us determine what level of sales we need to break even. All right. Now, not only do we want to break even, which is 0 profit, we also want to know how much we have to do in sales in order to earn a certain target net income. And the final concept in this module is a thing called the margin of safety. So let's begin now. This is the study of the effects of changes of costs and how they change in relation to volume and the effect that has on a company's profits. So there are 3 things: cost, the level of activity or volume, and the profit. It's very important for management, for profit planning. It's also very critical in setting selling prices, in production to determine what the product mix, the ideal mix should be. We should be producing the product that gives us the most profit, and also how to maximize or use production facilities. Now, as I said, there were 5 components. First of all, there's the volume or the level of activity. Then we look and we need the unit selling price and the unit variable cost. And lastly, the fixed cost in total. Now, we're using this model to predict the profit for a company that provides one service or one product, or produces one product. In the next module, we're going to look at companies that produce more than one product, and therefore we have to bring in the idea of sales mix. Now, we revisit the CVP income statement. Recall, we reformat the financial accountant's income statement into what we call the CVP income statement. Now, this is only for management's use. We reclassify the costs into those that are fixed and those that are variable, and we introduce the contribution margin. Now, the contribution margin is the amount of revenue that remains after I deduct the variable costs. Okay, so with the CVP income statement, for example, here we have the company. Unit selling price, 500, variable cost, 300, fixed, monthly fixed, 200,000, units sold, 1,600. So our CVP income statement would show sales, 1,600 camcorders at 800,000. Variable costs at 480, contribution margin 320, fixed cost 200, and profit of 120. So that is the cost volume profit income statement. Now we can determine not only the contribution margin in total, but the contribution margin per unit. And that is the difference between the unit selling price of 500 minus the unit variable cost of 300. That difference we call the contribution margin per unit. In this case, it would be 200. So therefore, when we look at the statement, we have the contribution margin in total, 200,000, and we have the contribution margin per unit, which is 200. Now the fixed costs are 200,000, so you can see that we would need 1,000 camcorders. Each of those camcorders provides us with $200 in contribution, and the total contribution on 1,000 camcorders is 200,000, and that equals my fixed cost. So I am at a zero profit at that level of activity. However, when I sell the next unit, after I've sold enough to break even, that is, I now sell 1,001 camcorders, well, the per unit, 200, becomes the profit because I no longer need that 200 to cover my fixed costs. So beyond the break even, the contribution margin per unit is the amount that the profit will increase with every unit you sell. And so that's the value of having the contribution margin per unit. So therefore, we can calculate the break even. Now, another way is by using what's called the contribution margin ratio. Now, anytime you have the word ratio, it means a percentage of sales or selling price. So contribution margin ratio means contribution margin in total divided by total sales, or contribution margin per unit divided by unit selling price. In both cases, the contribution margin ratio is 40%. So therefore, I can express my CVP income statement in terms of percentages. So sales is always 100%. Contribution margin is percentage. Contribution margin ratio is a percentage the contribution margin is of total sales, which would be 40%. Therefore, the complement is the variable cost ratio. That is, variable cost as a percentage of sales is 60%. So you see it always adds up to 100. Now, let's assume I know the contribution margin ratio is 40%. Now I'm going to assume that I want to increase my total sales by 100,000. So on the left here, you see we have the information. Sales is currently 500,000. Contribution margin is 200. Profit is 0 at this level of activity. The unit per unit selling price is 500. Variable cost is 300. Contribution margin is 2. Now, if I take 200 as a percentage of 500, I bet the contribution margin ratio of 40%. If I take 200,000 as a percentage of 500, I get the contribution margin ratio of 40%. This will remain constant as long as I don't change my selling price or my variable costs. Now, I want to increase by 100,000. The sales now go from 500 to 600,000. The variable cost, though, also increases. It still remains 60% of sales. So the variable cost is 360, and the contribution margin, which is 40% of sales, is 240. So you see, with a total contribution margin of 240, I only need 200 to cover my fixed, and I have 40,000 to provide me with a profit. Notice the per unit did not change, percentage, contribution margin ratio, and the variable cost ratio always remain the same unless we change the selling price or the variable cost. So in this case, yes, my profit would go up 40,000 if I increase my sales by 100. Now I'm beyond break even. So I would know that because the contribution margin ratio is 40%. So 40% of any sales beyond break even would always give me 40% of that. So the sales of 100,000, 40% of that is 40,000. This is called break-even analysis. Okay, and it's that level of activity where the total revenues, that is, the variable costs and the fixed costs, are covered, and I have a zero profit. Now, I can express break-even analysis two ways. I can determine the number of units I need to sell to break even, or I can determine the amount of sales dollars I need to achieve to break even. How do we do that? Well, we use the contribution margin technique. At the break-even point, the total amount of contribution margin must equal the total fixed cost. Okay, so the contribution margin, keep in mind, is total revenues minus the variable. So the contribution margin has already covered the variable cost. The question is, how much contribution margin do I need to cover my fix? Well, if the question is, how many units do I have to sell in order to break even, I simply take the fixed cost, 200,000, and I divide it by the contribution margin per unit, 200, and I get 1,000 units. And that's my break-even point in units. I have to sell 1,000 to cover my variable cost. And to cover my fixed costs. If I wanted that answer in total sales dollars, well, I simply take the fixed cost and I divide this time by the contribution margin ratio, 40%, and I get 500,000. Well, you see the units needed to break even were 1,000, and each unit is sold for $500. So I can express the same break even in terms of units, 1,000, or in terms of sales dollars, 500. So now here we have Lombardi Company as unit selling price of 400, variable cost of 240. Now you're never given the contribution margin, so you have to figure that out. Contribution margin, obvious, is 400 minus 240 or 160. And the fixed cost is 180. So what's the break even? Well, simply 180 divided by the contribution margin per unit, or 1,125 units. Now, the next idea is to say, okay, that's fine. We can determine how much we need to get zero profit, but I want to know, what level do I have to achieve to earn a certain net income? That's called target net income. And again, it can be expressed in units or dollars. Now, when I think about target net income, I'm looking for the required sales, enough to cover my fixed costs and cover my variable costs and cover my fixed, and give me a target net income. So there's my mathematical equation. What we do basically is required sales minus variable costs is the contribution margin, and we move the fixed costs over here, target net income plus fixed costs. So now to determine that level of sales, simply put, you add the target net income to the fixed costs and you divide by the contribution margin per unit if you want your answer in units, and that's 1,600 units. If I want it in dollars, I take the same thing, fixed cost plus the target net income, divide by 40,000, and I get required sales in dollars of 800,000. So to conclude, that's all we have to do is add the desired net income to our fixed costs and divide through by the contribution margin per unit if I want the answer in units, contribution margin ratio if I want the answer in sales dollars. So that's a tremendous benefit of using just the contribution margin. Technique. Now, a final concept here is called the margin of safety. That is the difference that a company is actually selling or expects to sell more than they need to sell in order to break even. That is, how many units more than they need to break even are they actually selling? Because if the economy declines, you see the number of units they're going to sell will decline. How far will they go before they hit the zero profit level? And that means it's a cushion. This idea is the idea of risk. This is a risk analysis. And basically, how far do sales have to drop before I am no longer in a profitable position? This is quite most often expressed as a ratio, but it can be expressed in actual dollars. So here we have an example. Actual sales, 750. What I need to sell to break even is 500. So my margin of safety in dollars is 250. So therefore my sales has to fall 250,000 so that if it does, then I'm at my break-even level of sales of 500. Most often it's expressed as a ratio though. And we do that by computing the margin of safety, 250, again, as a ratio, as a percentage of sales. So 250 divided by sales means that my sales have to drop by a third before I'm in a dangerous position. So the higher the dollars or percentage, the greater the safety. And managers look at this, financial people look at it and they compare the margin of safety in one company to the margin of safety in another, because you see this gives them an idea of how risky an investment would be in that company. So there you have the cost volume profit analysis, zero profit, target net income, margin of safety. Now I have many interactive problems that you can try in this module to deepen your understanding.